Joining us now from Odlum Brown is Leith. Hi, Murray.
Hi, Michelle.
Murray, a lot of people when they're thinking about making an investment want to make sure they get maximum return. And with that often comes higher risk. Can you speak to the difference between high risk and safer investments, or do the two sometimes go together?
Well, off the top, I'd say a couple of things. Number one, an investment sounds too good to be true. It almost always is. You know, you have to look at every investment and try and understand the risk. And particularly if it's a structured product that some financial institution is putting together, try and understand what's their end of the deal. What's their risk? What's your risk? And if you can't understand it, my advice is don't invest in it. My area of expertise is the stock market. So I'll speak to, how we look at risk in the stock market. And really we're looking at three factors when we're considering the risk of a stock. Economic risk, financial risk, and valuation risk. So maybe I'll speak to each one of those.
Please.
Starting with economic risks. Here the considerations are, how cyclical is the industry that a company's in? And also, where are we in the business cycle? Early in the business cycle, economic risk is relatively low. Late in an expansion, it's much higher. On an industry by industry basis, a pipeline or a utility company is a lot lower risk and more predictable than a mining company, for example. A company like Coca-Cola, their earnings are much more predictable. You know what their business is going to look like in 5 or 10 years. Whereas a company like Research in Motion in the technology field, the landscape could be completely different a few years down the road.
So really there's many, many things to consider. It's a very complex landscape. And this is where an investment advisor must play an important role, I would imagine.
Well, sure, that helps. The other two risks that, are levels of risk would be financial and valuation. So, on the financial front, we're really looking at the debt that a company has on their balance sheet. And more debt is higher risk. And a great example of that in action was Teck Resources in the latest cycle. They made a big purchase of Fording Coal before the financial crisis, put a lot of debt in the balance sheet, and that almost bankrupted the company when the economy went down. The stock went from 50 to 3. Fortunately for them, the economy rebounded, commodity prices rebounded, they were able to restructure the balance sheet, and the stock's now back over 50, and the financial risk is a lot more. But, debt can have a very profound impact on the stock prices. And finally is valuation risk. And, as prices go up, so does risk. And I think valuation is often an underappreciated risk. Think about how people behave in a bull market and what the media and strategists and advisors say in a rising bull market. Typically, risk is less of a consideration at the top, and after things have collapsed, it's much more a consideration and talked about thing at the bottom. But there's a big difference between actual risk and perceived risk. When people are running scared and talking about risk, that's when the actual risk is relatively low. So when people are fearful, that's when you get high prospective returns and relatively low risk.
Thank you, Murray. We'll see you again soon.
Thanks.
North of 49, a guide to the rest of your life.